This is probably one of the biggest issues that I see that investors make, and I think it's really important to highlight this and make sure I explain exactly why this is a problem. But just before we get too much into the details, let's just quickly get on the same page about dividends and understand what they are. A dividend is a payment provided to shareholders from a company's profit. Nice and simple, but let's just do a very quick example. So let's say company A here makes a profit of £1 million or $1 million, it really doesn't matter. And they decide that they want to pay out half of that in dividends back to the shareholders. So 500,000 will therefore be given as cash to the shareholders, and the more shares that each of the shareholders have, then the bigger the dividend that they're going to get. Now, it's probably the closest thing to true passive income that you can get, and it's why so many people out there love dividends. All you need to do is literally sit back, relax, and wait for that cash to get paid into your investing account. Now, here's where we need to start looking at the dividend trap and the multiple traps there are, and why I think it could be costing investors a huge amount of money in the long run. Firstly, just remember that when a dividend is paid, it is just the process of moving money from the company bank account to your account. Nothing is created and there is no new money, and all that changes is the fact that you now have the money and the company does not. At the point that this happens, the company becomes worth less because they now have less cash in their bank. There's no free money at all. This is just what happens. Unfortunately, there are lots of people that do not understand this, and I don't blame them really at all. And there are plenty of brand new investors who just assume that a dividend can be paid and nothing happens to the price of their stock. You have to remember that a dividend is just one way that a company can return a profit to you as a shareholder. A company can also take their profits and do other things as well. It really is up to them. For example, they can take that money and buy another business, or they could reinvest that money and buy some new equipment. Also, another thing they can do, which has been very popular recently, is buy back their own stock. Now, this has the same effect that paying a dividend does in terms of returns to you, except no cash gets given out. Instead, your shares become worth more because you now own more of the business as there are less shares out there in the market. You just have to imagine that a company is a pizza with lots of slices, which are the shares. Now, a dividend is them giving you a very small slice and you taking that away. But a buyback is them making those slices slightly larger for everyone. Either way, there's still the same amount of pizza left in total, and there's no magic shares and slices left, even if you are really hungry. So that's the first part of the trap, thinking that it's somehow free money. It's just one way to return a profit to you as a shareholder, and there are other ways to do it. Now, this is just one part of the trap, and I think the rest of the trap is what catches most people out in the long run, because most people do understand that a dividend isn't just free money, at least I hope they do, but by only focusing on that one thing, it can distract people from the bigger picture. Let me just show you an example and hopefully you'll really start to see what this trap is all about. Okay, so let's play the investing game. You're a long-term investor, you like the idea of investing in companies that pay dividends, and you've heard about this thing called the dividend snowball. You've been told that if you invest in good, well-established companies that pay a dividend, you can take that money and reinvest it year after year until eventually you can just retire early and live off the passive income. I think it's fair to say that this is pretty much the dream for most people, and it's what gets talked about here a lot on YouTube. In fact, I'd say that this is probably one of the biggest motivating factors for people who want to invest, as otherwise, what's the point? Right, so this is the route that you want to go down, and now you just have to make sure that you choose the right stocks and the right companies. This part isn't easy, but then you've heard lots of people tell you that you just need to look out for a few key things, and you should be set up for the long run. For example, you've been told that you need to buy companies with a wide moat, maybe something with a strong brand or a great product that can't be copied easily. Then you've been told to buy a company which has been growing its profits, growing its revenue, and most importantly, consistently increasing its dividend too, year after year. Now, all of this sounds great, right? And if you do this, you can end up with looking at some really popular household names like Coca-Cola, 3M, Johnson & Johnson, and even McDonald's. All of these companies are good examples of ones that have paid dividends for decades, grown their dividends, and been extremely consistent. Your next step is then to decide how much you want to invest in each one. You make your choices and then you get invested. Ideally, you're going to be investing for a long time, which to me would be something like at least 10 years, but even longer if you can, as none of this investing stuff works if you try and jump in and out every year. Your job is now to get in as much money as you can, get those dividends, and get them reinvested as soon as you get them paid. So, all sounds pretty simple, right? Well, maybe. I've skipped a lot of details and things to consider already, but hopefully you get the point that we're all on the same page. Now, let's rewind the clock and pretend that you actually did this as an investor. You chose those companies to be part of your investing portfolio. Over the last 10 years, assuming that you just put in one lump sum at the start to make this nice and easy, how would you have got on? Well, let's take a look and go through these one by one. Okay, so now we're going to look at the total returns over the last 10 years of these investments. Just to be 100% clear here, the total return is what you get when you add up the dividends as well as the price change of the stock. So the numbers you're going to see here in a second factor in reinvesting every single dividend to this number. It's worth noting that whenever you look at a chart on Google, for example, this does not include dividends and is only ever a price chart and not a total return chart. At the end of the day, all that matters is total returns. It's your money going in, and the total return tells us exactly how much we're going to get, including dividends at the end. Right, so with that explained, here's the numbers. Coca-Cola over the past 10 years has given you just over 108% return. 3M has given you 18.5% return. Johnson & Johnson has given you 96% return. And McDonald's, right at the top here, has given you 251%, which is the best of all of these picks, as you can see. So, not bad at all altogether. All of them made you money. And during that time, it's been a pretty wild ride as well. Now, are these returns any good? Well, clearly, you can see that McDonald's was the best performing one, but there was no way to know if that was a good investment 10 years ago because we just didn't know the future. Overall, you might look at these results and say you did pretty good, but how about just comparing this to something like the S&P 500? After all, what's the point going through all of the hard work, finding the right stock to buy, building a portfolio and taking all of that extra risk when you could just buy the whole global stock market or even the S&P 500 and do pretty well? So how would you have done if you just bought an index fund that tracked the S&P 500? Well, over the last 10 years, the total returns of the S&P 500, remember this includes dividends, is 220%. So from this small list at least, you would have beaten every company except McDonald's. You would have needed no research, no trying to figure out the right companies, and taken a lot less risk. Just put this into perspective for a second. If you are investing to gain passive income and maybe retire early, you would have twice as much money by investing into the S&P 500 than choosing a company like Coca-Cola, for example. For many people, I don't think you can afford to take that risk and guess which companies are going to perform well in the future, so I'd prefer to own everything. By picking and choosing any stock, you really are rolling the dice and just hoping for the best. Now, just before people say this is cherry picking and you know how to pick the best companies because you're an investing genius, bro, let me give you even some more examples, and rather than singling out stocks, why don't we just use the best of the best in a fund altogether? Two great examples spring to mind. Now, these are US-based ETFs, but they're still good examples for us to use here. Now, one of them is NOBL, and the other is SCHD. Now, both of these funds contain some of the best dividend-paying stocks in the world. If we look at their 10-year performance in terms of total returns, here's how they stack up. NOBL has given you 165%, and SCHD has given you 181%. Both of these funds have not even got close to the S&P 500 return of 220%. Now, there's no way to know the future, and moving forward to the next 10 years, anything can happen. That's not the point of the video to tell you what to invest in. I just want to show you that some of these dividend traps that people can fall into. After all, if these funds can't beat the total returns of the market, then why would you invest in them? Does it really matter to you to see a dividend payment get paid, even if you could end up losing out in the long run? Now, for some people, maybe you're fine with that, but that is actively choosing to underperform in the long run. And this could be the difference of retiring early or still having to work. Another trap is a common one, and this is when you choose your dividend stock because it pays out a high yield. For example, you might see a company paying out 7, 8, or even 10% back based on its share price. It's very easy for someone to look at this number and say, wow, it would be nice to get back 10% of my investment each year. That's almost like free money. And then my stock would just need to go up a couple of percent as well, and I'd be rich. Many people have fallen into this trap, and I don't think this will ever change, to be honest. I also think that this is quite common in the UK stock market, where many companies pay a dividend, and quite a high one too, especially when you compare it to the rest of the world. A good example might be these two companies like Vodafone and British American Tobacco. Vodafone has a yield right now of over 11%, and BAT has a yield of around 10%. Their share prices have performed pretty badly over the last decade or so, and many people can easily see this as cheap, assuming that they have to go up, and they can get the dividend along the way. But yet again, let me just bring out the real numbers and show you the total returns. If you take anything away from this video, I hope that it's this. Total returns are all that matters, and ignore that if you want to seriously hurt your financial future. Anyway, Vodafone over 10 years and BAT over 10 years look like this. Vodafone has actually lost you money more than 42% down. BAT has given you just 24% over that time period. I'm sure there's plenty of you out there who bought these stocks, and you can share your war stories in the comments section below. Maybe you didn't really focus on total returns before and you're only just finding this out. Either way, just be so careful. Again, in the future, this could look very different from now. You can't invest with hindsight, but you can think about what kind of strategy that you want to use. Of course, there are always exceptions, and there are good examples as well. Stocks can pay a dividend and beat the market with their total returns. Just because a company pays a dividend does not make it either good or bad. It's just one part of the investment that you need to be aware of. And it is right that a company should pay a dividend if it ends up with loads of extra cash. For example, you may have seen Meta and Google recently have both started to pay a small dividend after many years of never doing it at all and only ever buying back their stock because they've been focusing on growth. What I would say is that picking an investment just because it pays a dividend is like buying a car based on what color it is. Let's say you really like red cars and you're just going to ignore the rest of the features as you really like red cars. You're happy to ignore a car that might be more efficient, one that might be electric, one that might be more reliable, or even one that might be bigger and better for your needs just because they aren't red. It sounds stupid, but this is exactly what you're doing if you're only investing in companies that pay a dividend. It's just one factor of many that make up a company. Clearly, you'd want to look at way more than just that, but in the example of investing, you can do all of the research you like and look at all of the numbers, but there is no way you can know the future returns of any given company. If it was that easy, everyone would do it. And no amount of data today can tell you the future performance of a stock. Now, I do say that, but I will always find someone in the comment section who will let you know how great they are, and they never watch the whole video. Such a shame, eh? So what's the alternative? Well, from my own personal view, I just want people to understand the risks. Remember, I'm not a financial advisor, I don't claim to be some kind of stock guru, and I really want to just help people get invested, especially if you're brand new and you need to get help started as well. I'm more than happy for people to invest in whatever they like, so long as they are aware of the risks and they're happy taking them. What I worry about is that people don't understand the risk of investing in any single company, and they don't appreciate what a dividend really is when you consider total returns. Dividend investing for passive income and making a snowball sounds great, and it might help you get started investing, but just remember that anytime you make an investment into a single company, you have to take the risks that come along with it as well. An alternative, in my view, is to not focus on the individual companies at all and just do what it says on my t-shirt, index and chill. Rather than trying to pick individual stocks, why don't you just own all of the stocks in the market, whether they pay a dividend or not? You can be an owner of all of them with a single index fund. A lot of index funds will also pay a dividend as well because they own all the stocks in the world, or at least most of them. And then if you really want to have some fun on the side, then sure, go ahead and pick some stocks as well. But risking everything for the sake of a dividend is just a bit crazy to me. Please don't fall into the trap. Let me know what you think below. Happy investing.